Okay guys, this is the assignment we were trying to go over during our Class Connect today, and since we were having such issues with people getting booted out, myself included, I decided just to put this recording together to kind of help you with getting started with this assignment. So when you download this template, you should have 3 tabs down at the bottom. Let's see if I can get them all in here. Oh, wait, there they are. So an instructions tab, a part 1, and a part 2 tab. And darn it, I keep losing my tabs whenever I resize this thing. There we go. Okay. So your instructions tab, I kind of just put this on here to have an additional instructions page, I guess. But basically what we're doing is in each part you're going to run across different transactions that we need to then journalize and record in our journal. So guidelines for this assignment: make sure you're analyzing and identifying the accounts that are being affected. Classify those accounts as assets, liabilities, owner's equity, revenue, expense, or withdrawal. And that's where this reference guide will really come in handy. So make sure you are referring to this reference guide. Again, this is available in your announcements. I have a big bold announcement called "Download the reference guide here." And so that's where you can access the reference guide. So classify the accounts, apply the rules of debit and credit, create the T account, and then finally pass the journal entry. And we said that in class, pass the journal entry just means that we're writing the journal entry. So when we go to the Part 1 tab, this is kind of what we came up with in class before we all got kicked out. So with this first transaction, so we are Rex Consulting Services. We're doing the accounting books for Rex Consulting Services. They opened for business in January 2005. The company had the following transactions. So on January 15th, that's when Rex made the initial investment of $50,000 into the business. So we determined that the cash account would be affected with this transaction, as well as the capital stock account. So we have to base our account names off of the chart of accounts that is supplied for us. And so when we look here, our cash account is called cash account. Our capital account is called capital stock. So those are the account names we're going to be working with this transaction. And we determined that they're both increasing. So keep in mind, we're not concerned about Rex's personal finances, because a lot of you might see that he's taking money and putting it in the business, and you might think, well, then he's decreasing his cash. We don't care about his personal cash. We only care how it affects the business. So we're actually increasing the amount of cash that's going towards the business, and also increasing the amount of capital stock in the business. So what type of accounts are these, and how do the debit credit rules apply? Let's go to our reference guide. And hopefully by now you know cash is an asset account. And when we look at our assets set up here, we see that it increases as a debit and decreases as a credit. So on our explanation, we can say cash account is an asset and will increase on the debit side. Capital stock is, to go to our reference guide, and we hopefully know by now, whenever we see the capital in an account name, that is an owner's equity account. Okay, and so as an owner's equity account, it is set up to decrease on the debit side, increase on the credit side. So we said capital stock is increasing. I'm going to do a little merge and word wrap here. So capital stock is an owner's equity account and will increase on the credit side. So next step is to prepare these T accounts. So I have to fill in my account names that I'm using: cash account and capital stock account. Okay, do they increase or decrease? My cash increases on the debit side, decreases on the credit side. Capital stock decreases on the debit side and increases on the credit side. And then for the amount, so we said cash is going to increase as a debit in the amount of $50,000. Capital stock is going to increase as a credit in the amount of $50,000. Last step is to pass the journal entry. So now I go over here to my journal and I complete the journal entry. So on this day, January 15th, remember we always want to list the account that's debited first. Always list your debit first when you're entering your journal entry. So we have our cash account being debited. I go to my debit column and I put in $50,000. On the next, not 500, only 50. And then on my next line is where I put the account that's credited. This is going to be my capital stock account. This account, I go over to the credit column because I am crediting this account, $50,000. And we discussed in class that on this third line is where you would put your source document. In this Part 1 tab, they left that step out just so you would focus on the rest of the transaction. In Part 2, though, is where they start to give you those source documents, so like this memo number 1, and that's where you would record that on the third line. But since we didn't get a source document for this, we don't have to record anything on that third line. Okay? All right, so that completes number 1 for this assignment. We have our accounts named, we have them whether or not they're increasing or decreasing, we've classified them as assets and owner's equity, we've completed the T account to kind of understand how that account's being affected, and that helped us to pass the journal entry. Okay, so let's move on to the next one. January 17th, we paid $400 office rent for the remainder of January. Paid $400 office rent for the remainder of January. So I'm going to look up here at my chart of accounts and try to determine what accounts this is going to affect. So I paid office rent. I'm going to assume that that's going to fall under, look here, I have a rent expense account. So it's probably going to fall under that account. And then since I'm paying it, $400, that's also going to affect my cash. So I have a cash account and paying $400, so that's going to decrease my cash account. And I also have, I decided I was going to use rent expense, and the amount I'm putting towards my rent is increasing. Okay? Remember, when we're talking expenses, some of you get confused and think, well, that the amount's decreasing because we're spending money. But we're putting that money, we're taking it out of cash and putting it towards our rent expense. So that's how you should look at that. So our rent account, our rent expense account is actually increasing. We're increasing the amount of money we're putting towards rent. What type of accounts are these? Let's go to our reference guide. Again, I have this cash account up here as an asset, so I know that my cash is an asset account. Rent expense, that kind of leads me to believe that I'm dealing with an expense account here. So under possible names, I see rent expense, and really anything ending in expense we know is going to be an expense account. And an expense account is set up to increase on the debit side, decrease on the credit side. So go back to my assignment here. What type of accounts are these? Cash account is an asset and will be debited. Rent expense is an expense. Oh, and I already made an error. So my cash account is actually, we said it's going to decrease. And as an asset account, our cash should be decreasing as a credit. So I need to go back and fix that. Cash account is an asset and will be credited. Rent expense is an expense account and will be debited because we said it's going to increase the amount of money we're putting towards that expense. So that expense account is being debited. You will find that hardly ever do we credit an expense account because we're always paying off those expenses. So we're always putting money towards the expense. Very, very rarely, and I don't think ever in this class will you see an expense account credited. Okay, so cash account is an asset, will be credited. We're decreasing the amount of cash we have and putting it towards rent expense. So that account's being debited. Let's prepare those T accounts. We have our cash account and rent expense. I know my cash account is set up just like my cash account from above, so I can copy and paste those here. I also know my expense account is set up exactly like an asset account with a debit increase and a credit decrease, just like my asset account. So I'm actually going to paste those there as well. The amount, we're decreasing cash by $400, and we are putting that money towards rent, $400, and now we pass the journal entry. So we go back up to our journal entry, and this date is January 17th. Always, always, always want to list your debit first. So in this transaction, our rent expense is being debited for $400. Cash account is being credited for $400. That's what our journal entry looks like. Okay, and again, we don't have a source document, so we skip that next line. All right. So you guys can complete the next 4 transactions on your own. It's the same steps over and over and over again. So you're identifying which accounts are being affected, how they're being affected. You're classifying those accounts. Are they debit? Or are they asset, liability, owner's equity? Use your reference guide to help you out with those. And then you're setting them up with these T accounts in order to pass your journal entry. So let's kind of just quickly look at, maybe I'll help you determine which of these accounts are being affected, because I'm a nice teacher. So number 3, January 20th, purchased office supplies for $200. Payment is not due until February 15th. So that's a clue. We're not paying this yet. We purchased the items, one of those buy now, pay later philosophies. So that means we're using our credit with the account. Okay, so we're buying office supplies. So let's go up to our account, chart of accounts. Looks like we have an office supplies account. So that one's a pretty safe bet to say that we're using our office supplies. And we bought office supplies, so we're increasing the amount of money we have in office supplies. Payment's not due till February 15th. So again, we're not paying cash right away. Instead, we're going to be using this accounts payable. We bought these supplies on credit because we're not having to pay it right away. So office supplies is increasing, and then we also have accounts payable increasing. Okay, we're increasing the amount of money we owe somebody at accounts payable. All right, so I'll let you guys then do the rest of these steps. Classify those accounts as an asset, liability, owner's equity, revenue, expense, withdrawal, and then complete the T accounts, and then pass your journal entry. Make sure you're always listing your debit first. This next transaction, January 25th, purchased office equipment for $15,000 cash. That one should be pretty simple. Look up here, we purchased office equipment. So that's going to affect our office equipment account for $15,000 cash. So obviously that's going to affect our cash account. It doesn't say we're paying later or bought on credit or bought on account. So it's directly affecting our cash. Okay, so fill that information in here, then complete the next steps to classify those accounts in your T accounts and pass the journal entry. Performed consulting services and billed clients for $2,000. The entire amount will not be collected until February. So again, we billed our clients and we're not collecting until February. Performed consulting services. So that's a fancy way for saying we provided service, right? Our business is Rex Consulting Services. So we make money by providing consulting services. So that should tell you that that's going to affect our revenue account. We provided the service that our business provides. and we're getting paid for that service. So that is coming in as revenue. So this is going to affect our consulting revenue account. So we provided services, so that's going to affect our consulting revenue. We're getting paid $2,000, so that's going to increase our revenue account. All right, this next part that says will not be collected until February, that should be a sign that that's going to affect not cash, because we're not collecting cash right away. Not accounts payable, because this is money we are bringing in. Accounts payable is money that we owe. Accounts receivable is money that we are owed. Okay, this is money that someone else owes us. Accounts received, money to be received. Okay, so our consulting revenue is going to increase, and our accounts receivable, we are increasing the amount of money that somebody owes us. So that's going to increase. Somebody owes us $2,000 now. That's going to increase. What type of accounts are these? Pull out your handy dandy reference guide. We're working with consulting revenue, so that should be a sure sign that this is going to be a revenue account. As a revenue account, you'll notice we decrease as a debit, increase as a credit. Okay, and then we're also working with accounts receivable. Accounts receivable, we know, is an asset account. So we are increasing on the debit side, decreasing on the credit side. So what type of accounts are these? Consulting rev is a revenue account and will be, we said it increases on the credit side, so we're going to credit this account. We're increasing the revenue coming in. Accounts receivable is an asset and will also increase, but we're going to increase this account on the debit side. Okay, you guys can complete then the rest of these T accounts. Make sure you're filling out which side increases and decreases for each one. Use that reference guide, and then you're going to pass the journal entry. So go back up here to the journal and fill in that journal entry, always listing the debit first. The debited account listed first there. Okay, next one and last one for this part. January 31st, recorded a $100 utility expense. That's going to look pretty close to our other expense account that we paid for. So we have a $100 utility expense that we're paying. How is that going to affect these accounts? We're paying $100 towards our utility expense. Let's make sure we have a utility expense account. There it is. So we'll be using utility expense. We're paying $100. So that should affect our cash account. And I think you guys can determine the rest, whether or not they're increasing, decreasing, classifying those accounts, and setting up their T accounts, along with passing the journal entry. Oop, that was down here. Okay, so that's the last one for part one. Once you get all of your journal entries put in, a good way to double check to make sure you did everything correctly is to add up your total debits, and they should equal all of your total credits. So once you're done making your journal entries, add up all of your debits together, write that number down, add up all your credits together, write that number down. Those two numbers should equal. Okay, let's move on to part two. Part two is set up very similar. You are analyzing the transactions. The only thing we're adding into part two are these source documents. Okay, so that's what we would record on that third line. So let's look at this first transaction. On January 5th, Mr. David took $20,000 from personal savings, which we don't care about, and deposited it to start his business in the name of David Transport Service. This was recorded on memo number 1. So which accounts are being affected? Let's go to our chart of accounts. Just like we said in part 1 of this assignment, Whenever we're putting money into the business, we know that's going to affect our capital account. So David's capital is going to increase, and our cash account. Okay, we're making that initial investment into the business of $20,000. That's going to increase the cash we have in our business and the value of our business in the capital account. What type of accounts are these? Let's go to our reference guide. Hopefully by now this is kind of becoming routine. A cash as an asset, increase as a debit, decrease as a credit. A capital account is owner's equity, decrease as a debit, increase as a credit. So how will the debit credit rule apply? So we said David's capital is increasing. Let's say D capital will be credited because it increases on the credit side. Cash account will be debited as an asset. Okay, and then we should probably put David's capital as an owner's equity account will be credited. Cash account will be debited as an asset. Prepare the T accounts. We have cash account and David's capital. I'm going to go, and I don't like to type in all of these pluses and minuses all the time. I'm going to go copy it from my previous page and paste it in there. And then put in the amount is $20,000. Okay, so now we pass the journal entry. January 5th, the account name, we always list our debit first, so we're putting in cash account, debited for $20,000. David's capital being credited $20,000. Okay, then on this third line, this is where that source document comes in. And all we have to do is put memo number 1. Okay, that tells us that from the source, memo number 1, that was the document that gave us this transaction. And this is how it is recorded into the journal. Okay, let's do one more together. On January 6th, David Transport Service issued check number for $2,000 to buy a computer system. We say that check is as good as cash, so he's paying it right away. So step 1, which accounts are being affected? We bought a computer for $2,000. So let's go up here. We have a cash account, so let's definitely go with that one. We also have a computer equipment account. Okay, so that one's also, we're buying a computer, so I can guess that one's going to be affected. Notice the numbering along the side here. This is what we learn about in this section of the unit, is our account numbers. You'll notice all of our assets start with a 1. So that can help you out too if you're stumped on what type of an account computer equipment would be. Well, it starts with a 1 in their account number, so that tells me it's an asset like all these other number ones. Accounts payable starts with a 2. That means it's our liability account. And any other liabilities account, they would also start with a 2. So maybe if we also had a taxes payable, that would be 2.2. Or a notes payable, that would be 2.3. So all our assets start with a 1. All our liabilities start with a 2. Our owner's equity accounts start with a 3. Our revenue accounts start with 4. Expense accounts start with a 5, and withdrawal accounts start with 6. So if you're ever confused by how you're classifying these accounts, just look at the account number, and that should help you out. All right. So on January 6th, we said we wrote a check for $2,000 to buy a computer system. Cash account is going to decrease because we're writing the check for $2,000 going out of our cash and going towards computer equipment, which is going to increase the value we have then in computers. What types of accounts are these? Cash, we know by now, is an asset account and will be, since it's decreasing, We look at our reference guide. It's going to decrease as a credit because it's an asset. Computer equipment is also an asset and will be debited. Because remember, with every transaction, we should have a debit and a credit. Every single transaction we have needs to have a debit and a credit involved. Okay, next step is to prepare these T accounts. I'm going to leave that up to you. These are both asset accounts, so you should be able to set up that T account just fine. Then we're going to pass the journal entry. And so on the next line available, say January 6th, our debit we said was computer equipment. And we debited that account for $2,000. We credited our cash account. We put that over in the credit column for $2,000. And this whole transaction was recorded on check number 506. And we're done. Okay, so I will leave the rest of these to you. Let's just look real quickly. On January 10th, we paid $100 for a phone bill. Okay, so you can do that one on your own, recorded on Memo 5. January 15th, David Transport mailed check. So check, that means it's coming out of our cash account toward the month's rent. Okay, so that should be pretty simple for you to set up. On January 20th, David wrote check number 508 to withdraw $500 cash for personal use. We are withdrawing money for personal use. So looking up at this list of accounts, which account do you think a withdrawal would affect? Hopefully you are thinking this owner's withdrawal account right here. So we wrote a check. Our owner is withdrawing money to use for personal use. So we're only concerned on how it's affecting our business. So we wrote a check. That means it's coming out of our cash account and it's affecting our owner's withdrawal. If we go to our reference guide, we are increasing the amount of money we're putting towards the withdrawal. Okay, we're moving that money from cash. So we're moving that money from cash and we're putting it towards the amount of money we withdrew. So hopefully that helps you with setting up that account or that transaction, and it was recorded on check number 508. Okay, so that should be enough to get you guys going on this assignment. If you have questions, please let me know.